And today's topic is discover business partnership. So discover just means that to find new things. So many times, if you type into business partnership on the internet, what you got is all legality things, is all contract. It is about the lawyers and helping you and protecting you. Did we realize that in business world, it is so unique? Doesn't matter how good of a contract you have, you can still get into litigations. So I'm not going to even try to protect anybody from being sued, as the USA is a capital of being sued. And if you decided to develop a business here in US, and you better mentally prepared to be sued. That's just what it is. And if you prepare yourself and mentally strong, and you will get through. So that's my second book. My second book is about growing the business and growing your mental toughness. And at the same time, and really focus on what? And in today's talk, I only want to focus on money and a real life example. So I am not tackling anything or making comments on legal side of things. Of course, you should have a good contract when you have partner, but I want to talk about money. I want to talk about if you do this, how that hurts you or benefit you. If you do that, how that would help you. And I have a real life experience, and I give the name to those stories so you will remember their name. And in case you need to kind of come back to Community CPA, wanting to get into our business consultation service, and you can refer to those names and we know which scenarios you're talking about. Now, so whenever we talk about partnership, folks, we are literally dealing with humans, right? You partner with somebody. So that human factors, I actually try to simplify it, because in business, you see some people got into partnership, they flourish, they really did really well. But there's also partnership, you just got in, you need to get out because they're already suing each other, right? So there's a human factor. So in my 8 a.m. book, I actually classify our business owners to be 3 types of people. I say that people who are in business, when we get into the business, we are all immigrant in that sense, imaginable immigrants. So you either coming from land of hand or land of heart or land of head. And let me give you the definition. You probably already guessed it. If you are coming from land of hand and you are the kind of person that you know how to cook, and you go, well, I'm such a good cook, I'm going to open up a restaurant. So land of hand person, start a restaurant. That's very typical because you're good with a skill, so you went into business, okay? And then what about land of heart? Land of heart people are the one that they got into business because they have a feeling to express. And that's literally how I started Community CPA. I'll tell you, I have no reason to be in business, no reason at all. But the only reason I got into business because I am from land of heart. And I have people who come to me in such a bad situation. And I spent 4 years time to untangle them. That's in my first book. That tells you how I got into business. It's a fish market story. So land of heart people, they go with feelings. Oh, I'm in business. I'm just going to make money and save the world. I'm going to donate all my money to the nonprofit. I'm going to be a soldier for the good heart, right? And that's land of heart. There are a lot of people going into business because of that. Of course, there's also land of head. Land of head people are the one that already calculated. They know that they want to make money and they already knew that they can make money, and they don't go by emotions. They open business, close business as long as they make money. And in my first book, I actually have Donald Trump, President Trump at the time, to be the land of head person. That's why he has business all over and across industries. So he has real estate business, beauty pigeon business, university business, and whatever he get in, and he already decided that's how he gonna make money. So nothing wrong with people like that. So, but I want you to know who you are. If you know which land you are coming from, and you know when you do partnership, you need the other two kind of people. So we say that in a business land, in my first book, it says that if you want to be successful in a business land, you got to have the three kind of people. If I am a land of heart person, just like I said that I was, and when I started business and I was, really into helping, but if I don't have enough skills, or if I don't have someone there watching what I do, I could do wrong things, and I could be not having enough skills and not to be able to help people. So I hire people, and with land of hand, from land of hand. Then I'm very lucky because my husband, Professor Hao, and he actually is from land of head, and he is very neutral, and he doesn't get wrapped around with what's going on, and he is more analytical and understanding, and his guidance was important in the very beginning of the year of community CPA. So with that said, I already set a foundation on the human factor. So when you want to discover this business partnership by first discover yourself, really knowing who you are. And I do have a quiz in my first book that make you decide who you are. You can check it. It is possible that you are both. It is possible, but it is almost difficult to become three. Some people, maybe very rarely you will become three, but if you are all three, that just says that you have a really huge mental capacity and you are just a natural entrepreneur, you're going to be successful. But most of people are one or maybe two, with one being major, the other one being minor. So you can test yourself to find out who you are, and then you can decide who would be your partner. So this is where the first step to go, discover yourself. Then second step to go to know where is your shortcoming. So if you are land of hand person, you know how to cook, obviously you need a land of heart people to be in the business. Maybe they're your partners and maybe they are your employees, and very well could be another firm. A lot of companies, they are hiring community CPA to be their service provider because they're hiring us as the land of head. They're hiring us to be looking after and making the balance and making big decisions without being emotionally involved. And we can look at that company picture to make a decision for them. So, and this is where a human factor. But what is another factor? And on the discover side, I only have two to offer you. One is human factor, which I talked about. And I know that that human factor alone, we can sit here and talk for hours and hours, and it would never end because humans are the most complex animals on planet. We are just not simple, but try to simplify that is important. It is not that we're silly, we just simplify it to the degree that doesn't even make sense. No, in business, the biggest skill you would have for yourself in partnership is to simplify. You want to simplify the relationship and you want to simplify yourself. Untangle yourself from the complex feelings, recognize yourself who you are, and then that's the best way to go about it. Now, what is the technical factors that you need to discover? So every time when we talk about partnership and you come, your thought kind of go into contract. You think right away contract, and I'm going to have this perfect contract between me and the partner. And so many times in the process of making that contract, you already break up because the contract was so detailed. It is even talking about what if one of you die and what's going to happen. It's just like ridiculous. And it's almost hurting your feelings sometimes, right? And you were a good friend, but after signing up this contract, and you might as well be an enemy. So the technical factor a lot of time lead you to the contract, but here I want to lead you to the structure, to the structure for taxes, to profit and the loss. So I want to talk to you about profit and the loss structures when you have a partner. So in here, what I will do is I will start sharing the screen with you. I want you to look at a whiteboard I have, and I will start drawing on here, because this is where the real understanding would get to you. So let me move my whiteboard over. You haven't really seen that yet. And Kat, can you make sure that my whiteboard works? I'm going to write a word on there and to make sure, is it working?
I don't see anything yet.
You don't see, let me reload it. Yeah, I will reload because I realized that sometimes I need the second reload in order that to show. So now do you see Ying on there?
Yes, I do.
All right, so just since I am here, I'm going to just write down my email address. And so each one of you can have it. Now, so I am going to talk about the structure, profit sharing. So in partnership, normally for small business, we have these entities to have a partnership. You probably already asking me questions saying that, oh, I thought it's only LLC. No, you can be a partner in any of these entities. So when you have a profit, it is dealt differently. So in LLC, I want you to understand a concept on LLC. So let's pretend this is your LLC. There is a really important contract in three different sharing method inside of LLC. I'm going to write that to you: profit and the loss and equity, or you call that ownership. So what I want you to understand is that when we make, let's say under each of the entity, we're making $10,000 profit. And under LLC structure, and your ownership could be 50-50, but your profit sharing could be different. Your profit sharing don't have to agree with your ownership, and profit sharing could be 90 and 10. When come to losses, what if you didn't make money and you lose money? And that could be done differently too, could be reversed. See, this is agreement. So when you have a partnership under LLC, you ultimately need to make this agreement. But so many times when we have clients coming in with a partnership and this agreement was silent, they didn't have anything on here. So they default whatever here is equals to whatever up on top. But that defeats the purposes of being a LLC, being a partnership, because you want that flexibility. And you want to be able to say that, well, you know, we agreed on ownership 50-50, but you know, I am the one bringing you all the clients, so I'm going to have a little bit more profit than you. So that is totally doable. Okay, so that is LLC. And in S-Corp, I'm going to draw this thing again. Of course, in S-Corp, and we still have the same issue. We have profit, we have a loss, or maybe loss, or ownership, or shareholder, right? But in S-Corp, there's no such a flexibility. Everything has to equal. So if your ownership is 50-50, then it's the same as on top. okay? And what about under C-Corp? So before I go to C-Corp, I want to conclude something right here with you. And these two entities, S-Corp and the LLC, they are called what? These entities are called pass-through entity. What does that mean? It means that they produce K1. This K1 went into your 1040 to pay taxes. Same, 1040. So your company doesn't pay any taxes, doesn't pay income taxes, okay? And it's all got passed through. That's why it's called pass through. It is all got passed through to your 1040 to file. That's why sometimes you hear people saying that my tax is due on March 15. It's not because their taxes due on March 15. It is their company tax return is due on March 15. And their 1040 is due on April 15. That makes sense, right? You got your company finished, then you got your K1, and then you can file your taxes under your 1040 with the K1 in there. So this is where pass-through entity comes, but no, the big difference is the partnership in here, it is a lot more flexible under LLC, but less flexible under S-Corp. Am I right? And you can see why that is the case. Now, what about C-Corp? What about I partner with another person? We open up a C corporation. But before you do that, you also did what you did on S Corp. So it is still the same. So the ownership dictates everything else. So your profit and loss, everything is reflected on the share. But the C-Corp has one thing is different. The C-Corp is not passing through. They're not bringing the end result into your personal tax return. So let's look at what C-Corp does. So the C-Corp is almost like a basket. This is a basket. The bottom is sealed up. So what's inside of C-Corp stays in C-Corp. So even though we have the ownership, but the only time we're going to see benefit of the ownership is not at the end of the year like these ones, like the S-Corp, C-Corp, because if we don't do dividend distribution, and then nothing would go to your 1040. Of course, you could be getting W-2 from here. That would go to your 1040. And if company decided to distribute dividend, they will give you the dividend 1099 DIV. This dividend is based on the shares, based on the number of shares, shares number in the system. So let's say if we have 100 shares, 50 is yours, 50 is mine, then we have a $100 dividend, then that means your dividend would be $50. So you see, that dividend distribution is actually, again, based on your ownership. So it is no difference whether it's profit and loss. If it is loss, you don't have dividend, you don't dividend anything out. But unlike S corporation, if you have a loss, you will distribute the loss as well by percentage. But that percentage in S corporation is exactly the same as the ownership. So there is no difference. Like the LLC can be different, but here is always 50-50. Here is always 50-50. So now we have an understanding on the tax structure, how that make difference for the profit and for the loss based on the ownership. So let's say if I have, a project on hand and I needed help, and from a person who with a lot of money, what do I do? So now I want to start talking to you about real life experience and the examples that we know with our clients. So let's discover how Francis did the partnership. So that is a story on my in the book, in the 8 a.m. book on page 115. So this is Francis. Francis is a young man, and he is very good with fixing and flipping the homes, and he's just really talented in that work. And Leo is a gentleman that much older in his 60s. And Leo and Francis met in the bar. Okay, so they got into conversation, and Francis has a couple of properties that he saw. It would take about $250,000 to buy them, but once he bought them, he could have done a lot of work to it, then flip it and sell it and make money. So a partnership began between them. So now let me give you the understanding of the, okay, so I'm going to clean my drawing here. So now, so what happened is Francis and Leo, so they decided to form a partnership. And they want to form an LLC because Leo is going to put in 250, and Francis put in $0. But they decided on the ownership side, they go on 50-50. So if there is a profit made, because Francis is the one really worked the work, right? So he is the one doing all the fixing and getting it done. Although he had 250,000 from Leo, so the profit of the selling, and that will be, they agreed, Francis would have, oh, that's a Leo's space. So Francis would have 60%, 40% would be on Leo if there's a loss. And Francis and Leo talked that extensively. And in this particular case, and you notice that all the money is coming from Leo. So if they have a loss, and Leo said that, let me take 90% of the loss because I invested in the business and I am the one giving you money, and you don't even have any reason at the base to deduct your losses. So I'll give you 10%, I have 90%. So the losses for Leo, it is 90%. You see how they structured the partnership. And so they go together to the attorney and giving this arrangement and form a contract and form the LLC. That is how that partnership started. And in the end, if really one day they want to, they build, and this company had a reputation of building, flipping homes really well. Someone wants to buy the partnership, wants to buy their name. Maybe their name is just really worth something. And that profit, that capital gain of the name will be split 50-50 because that is the sale of the partnership, right? So this is where a structure can be made by having one person put in money, the other person doing the work. So that's one of our real life experience, real life story. So now let's look at another one. The other one is called James and Sneha, James' story. So in this story, James and Sneha are a husband and a wife. They together owns many companies, but they're all LLCs. It's a husband and wife, so they always did 50-50 everywhere. And each of the LLC representing a hotel. So hotel A and a B and a C. So in this partnership, it's husband and wife. So it's not important to their concern to have this partnership be different from the profit and from the loss. All three, they don't care, they're okay because they file a joint return. But what is important to know is Sneha, the wife, never ever went to the partnership to work. She's a stay-home mom. But on their 1040, the K1 come in for James. K1 also come in for Sneha. They are treating them equal. They're treating both of them as working in the LLC, in the hotel. So what we need to make sure is that to classify one of them, this one is not working. This one, yes, working. The one who works would take the K1, like this one, and that dollar, that income, will be taxed for self-employment tax because James works. But what about the one not working? Sneha, is her dollars should have self-employment tax? The answer is no. See, this is when you have the partnership to make sure that the tax treatment is also correct. And of course, if you go ahead, pay 15% on Sneha, nobody would bother. How would government know whether she works there or not? Only you do. You know your partner don't work there. When your partner don't work there, you should not give him a K1 that give her the K1 that make her pay self-employment tax. So you should classify Sneha as a passive. The earlier story related to Francis and Leo, remember that story? And Francis will get a K1 that he will pay self-employment tax. But Leo would get a K1, is a passive K1. He doesn't pay self-employment tax. So in the partnership, you see, this is important. And to give you an understanding, this is a real life example we have. Just this one correction on Sneha for all of the hotel. And we're talking about aggregate $65,000 per year overpaid taxes in the past. So when they come to community CPA, that is the thing we discovered. And just by talking to them, realize that the lady never even go to the hotel. And her ownership is really passive. So she should not be paying self-employment tax. Okay, so this is another example. When we talk about business partnership, discover the tax saving that you should be having, and do not pay tips to IRS. 15% is a good tip, but I don't think anybody appreciate that. Even IRS don't want you to do it wrong, because if the partner is not actively working in the partnership, he is a passive investor. He's not a partner who should be paying self-employment tax. All right, so now let's talk about the other story I have here, which is Jose Hernandez. He's also a character. He's also a real person, but of course, I made him a character in my first book. So he is the gentleman that came across the border and stayed in US, but he is from land of hand. He knows how to fix machines, okay? So he knows how to fix machine and he's good with that. So he started a business just to be fixing lawnmowers and small compliances. And over the years, it's becoming a warehouse site where he was fixing bigger machineries like John Deere's track and things like that, tractors and things like that. So Jose also have a business, but because he is an I-18 holder, because he didn't have social security number, so his business is a C-Corp instead of other entities. So he formed that as a C-Corp. So the C-Corp is doing business on its own. Remember the C-Corp I was drawing earlier? And that C-Corp he has, and he was the only owner on that C-Corp. Remember we draw the C-Corp as a basket and with the bottom sealed up. So when Jose has income, it stays right here. So the income pays taxes on corporate tax rate, and he pay himself and on the dividend on leftover. So he pay himself 1099 dividend to support his family. And the story about partnership here is, so he is 100% shareholder. He grew his business so much that he needed a bigger warehouse to host the business, to install the lifters and whatever he technically needs to do. And the warehouse he likes to have, the owner, the landlord is an older gentleman, and he has a young son the gentleman gave the warehouse to, and this young son doesn't really have a lot of interest in being a landlord, but really like the business Jose is doing. So two of them get together to talk, and Eric wants to charge $5,400 a month on the rent. And Jose really nervous about that commitment because that will be his biggest expense up to that time. And he really is nervous. He doesn't know whether he will make it. Of course, a bigger space and he will do more repairs. So in theory, it should make it, but he doesn't know. So in this case, and both of them came to our office. So what we did is to have them have an agreement, which is more like agreement on the partnership. So what we did is we have attorney drafted an agreement for them. And Eric, remember Eric really liked that business. So Eric will get percentage of the business if Jose failed to pay rent, monthly rent. So at that time, so what we did is, number one, we did a valuation for this basket. We did a valuation for this business. We said at that time, we said that, oh, the business worth, the valuation can be done based on the financial statement, and you can get a valuation done. And in our firm, we develop we develop our own ways of doing business valuation, and we use the net asset and the income and the profit to come up with a formula. So we decided the business Jose has at that time worth 100,000. So now, because we know it's 100,000, and we also know that Jose has 1,000 shares. So each shares, you can imagine it is 10,000, 10K on each share. So if Jose not paying rent for 2 months, likely she'll get 2 shares. Am I right? So that is how we calculate the mathematically. So if Jose fail to pay rent, then we will give Eric that share. So each month is calculated that way. And if Jose never failed to pay the rent, everything went good, then there is no ownership transfer. So this is where the partnership can be such a flexible tool, right? I only want to demonstrate this to you because I want you to understand partnership doesn't just need to be LLC. And here you have Eric and Jose came up with a creative way so Jose can move to that warehouse. In reality, as of today, Jose have never failed to pay that rent. So as long as Jose is still renting the place and Eric still have the right to gain the shares if he is late. But if he's never late, Eric is still there, but as a landlord got paid, but did not need to get into the ownership. And then later on, when Eric got tired, remember he doesn't want to be a landlord. So Eric decided to sell the warehouse to Jose, and then Jose just put in an installment agreement and start paying, instead of rent, start paying for contract purchase of the warehouse. So this is where a creative way of partnering something with somebody who is what you short. So Jose short of a place, so he partnered with the landlord. And if you're a land of hand person, you're short of a land of heart, and then you would either partner or you hire that person. So a lot of time we see people partner. When we say partner, really want to be open-minded, because that also means that you can hire professionals to literally be a partner. And believe it or not, I have a partnership as well. I actually partner with the mentor. So I have a mentor who teaches me how to run business. So that is where you can make your partnership work by either engaging on an equity purchase or simply as a bill pay relationship. So discover that partnership, it doesn't need to be a cookie cutter. It can be very creative in so many ways. And then you will find when you grow your business, it is very much a necessity. It's not a choice, because you can't really do the business without all of the other elements to come together. Now, we look at the entity for Jose, and he has an IT number. He contracted with Eric. And I also want to introduce to you right here another concept, which is really related to your partnership. You know that you can also partner with an entity. So this is how it works. Sometimes you are a business. So you are a business. But some other large company come around. There's a large company come around. They want to buy you. Or they want your business. This has happened with one of our clients. So what he does a computer side of technology, and he developed a large company, national company come around, want his business. So what happened is of course, you can just sell your business and walk away. But what happened to our client is he created a creative partnership. So the large company wants to buy. So he sold 60% of the company to the large company. So he got a lump sum of 3.5 million. And he still holds 40% in his own name. So he has this partnership, and the partnership has a legal name. That's what he used to be. I'm just gonna say is an ABCD. He used to operate under ABCD, but the big company come in and wanting to buy him, and it didn't buy, and it did only paid 60%. So what happened here is they develop a DBA name, which means that the DBA name means that you don't change your name to your customer and you're trying to keep it consistent. So the DBA name become ABCD to replace that. The legal name become the national name, and with the local, for example, if it is Bloomington, so it is the national chain, is a large company name, Bloomington. So that's the legal name. But to the outside of customer, you can tell that they have no change because they were using the DBA name. But legally it's changed because the partnership becomes 60%, 40%. So our client still have a share, still have an ownership under here. So you could partner with a company. See, this 60% is not a person, it's a company. So this company would get a K1 to the company. So it will be included in the company's tax return. The company file 1120. So it will be a income come over here from this new firm, new LLC. So this K1 is to a person. You see how partnership can be so flexible. So you really want to explore that when you get into a situation where you are going to have a partner and do a partnership, and to be sure you explore all the possibility that is there. Everything can be resolved by getting the partnership structured right. Okay, and a piece of document, a piece of Word document would never cover everything. And what should be considered is more of the thought process to implement that from a human factor to technical factor, then summarize it up in a legal document. And that is really probably can be the best tool you have. Then I have another story which is on Emily. This is, again, is another partnership issues that we see all the time. And remember, sometimes you partner with someone and you just feel like it's not fair. And I'll give you an example why it is not fair. And we have a client, she partnered with another person, operated a job agency. So they supply laborers to large companies, large, small, other companies. So they're the job agency. So two of them are there and to work the job together. But one lady, Emily, has a really huge home. Emily's husband is well-doing. And so they have a house, like they bought it for 1.5 million. After the renovation, I think her house is worth 2 million. So you can imagine that Emily's home office is no small deal. Emily is 50% of that partnership. And then the other person, let's just say is Erica. Of course, it's not a real name. And so it's another 50. And they file 1065 together, okay? And they didn't really divide. They didn't really do anything different. They keep it the same. They didn't split profit and loss and anything. They keep everything the same. And Emily has a huge home. Her home expenses, her home office expense is like $5,000 a year. Erica don't have a home, just apartment. And she pays 800, I'm sorry, 800 a month. She's by herself. She has a 1-bedroom apartment, 800. So no matter what, Erica not going to come up with 5,000 home office expense. Did you see that? Okay. So under 1065, and if I bring these things into the business, deduct that as a business expense, it is not fair, right? Because part of Emily's expense is going to go to Erica. It is not fair. Emily said, well, I have a big home. I have more expenses, but I don't get all the deduction, right? She's not wrong. If they have a 1120S, if they have a S corporation, they're doing this, there's no cure to it. It's not fair. Okay, might as well just tell the partner that don't even deduct anything, but that's really not fair because with pandemic, who doesn't work from home, right? So if they are 1065, that can be dealt with because in K1, 1065, you can reduce expenses that you can reduce your K1 income by the expenses that was not reimbursed by the partnership. So in this case, actually, Emily and Erica both came to my office and they both, they're very nice to each other. So they are not fighting, but they're saying it's not fair. Can you help us to figure this out? So to figure that out, they need to be under partnership. And then we will have the K1 expenses. So let's say if Emily got $100,000 K1 income, and then the 5,000 will be reduced in her own 1040. So it's not related to Erica. And Erica, on the other hand, don't have a lot of expenses. So Erica got $100,000 income as well. But she only need to reduce that 800, let's say half of it is used for business, so $400 a month instead of $5,000 a month. So Erica can do her own calculation, file her own 1040. See, they're being fair now, right? So this is where one situation happens in partnering with your partner, there's always a technical solution behind it and look for it. Maybe you don't know what that is, but obviously come to consult with community CPA, which get you there. So this is where we say you discover that partnership and how that's going to work for you in business. Flexibility is everywhere, folks. There is no such a thing about cookie cutter solution, but by knowing all of these answers, it's going to help you to pick out the one that is going to work for you the most. And one thing, and I want to share with you another screen to show you the forms with IRS to further enhance what I just said to you throughout. So this one, the last point I want to give you is that in partnership, it is a growing process. And please know that to form a new partnership is normal. To dissolve the old one is normal. And it is normal to depart, but it is the best to know ahead of time to make sure that departure is peaceful. So we don't want you to get into partnership and to get into a lawsuit. And in early years, when I was doing community CPA, I actually hired a mentor and who is a CPA firm owner, but closed her business. So I hired her because I want to know why she would close her business. So the story, long story short, she has a really successful practice. Then she got a partner coming in. And after the partner coming in, things fall apart. Not only fall apart, the partner is suing her. So with that, she doesn't have a choice but to close her business. So see, that happens. And I don't want any of the business owners to end up there, but to discover what can protect you and what technical things we can put in place so you can run better business. That would be a huge plus. So now let me stop sharing this screen. I want to bring you to the screen I prepared for you. And here I'm on internet. Okay, so this is our YouTube channel. Since I'm here, I want to tell you that, and you can come to our YouTube channel, subscribe to Community CPA. These are all the videos that we have since last year. And I just did one on Tuesday called Huge Changes for PP Application is really worth of your time. You should watch that one. And we're updating that throughout. So, and of course you can register our webinars here, and this is our website. And on here, we actually encourage our folks to go onto YouTube to subscribe us. And that way we can disseminate our knowledge more effectively. And this is the book that on Amazon, this is the book I show you, has a lot of content related to, has a chapter called, Do I Need a Partner? I think is a chapter that helped a lot of people. I hear people talking to me about how that chapter would help them. But here, what I want to show you is Irs Forms. The reason I want to show you the form, because as much as I already told you this and that, I want you to understand that this is the particular technical details that you need to know a little. Don't have to know everything, but you need to know a little. 1065 is a partnership filing. And in this partnership filing, and you want to know that when you file 1065, you got that option for profit, loss, and ownership. And the reason I say that, I want you to see this one. See, this is the 10K1 I was talking about for 1065. Did you see that? 1065, right? And come over here. Did you see right here, the partner's share of profit, loss, and capital? Beginning, ending, loss, beginning, ending, capital, which is equity, beginning and ending. Did you see that on the tax form? That actually asks you to define it. And then you can have a beginning, you can have an ending. That means you can change it. Okay? So I just want you to come to realization that you have that flexibility in partnership. So you don't have to, think that if someone give you 250,000 to do business, then he's going to take all your business. No. And you can define that. You can have the 250,000 investor to only have 10% of equity. That's your decision, okay? And then in 1120, this is something I want to show you too. So this is a K1 for 1120S. See, K1 for 1120S, you saw that? And did you realize that they don't have that column I was showing you earlier? See, this is the partnership one. See this one? This is the partnership one. You can break that down. But for 1120S, for this one, for 1120S, you see, it just have a current year allocation percentage. It doesn't have the choice. This percentage is determined by equity share. So remember the chart, I have 3 layers. Under S-Corp is all the same. Now, for the partnership, I also said that you could take your own expense into your 1040 to report, okay? So that one, I also want to show you, that is in here. See, I had an example for you here. And if you can look, and under the part 2 of Schedule E, okay? I hope, I'm looking for a mouse, okay, here. Part 2 of Schedule E, did you see that line 28? There is a UPE. And this is where that expenses, the home office, Emily would put in. Emily gonna put in 5,000, but Erica will only do very small amount. Oh, 5,000 is per month. So, Emily will put in the big dollars and Erica will put in the small. Did you see that under K1 from 1065 right here? And let me just give a little bit blue pen. Okay, so under here, so this is a K1 from 1065, right? So that is this number. I'm looking for my mouse. Okay, I found it. So this is the 12,500 K1 has profit. But the K1 also have a deduction. The K1 also allow you to have a deduction. So that is this 500 right here. Okay, right here, 500 right here. See, then you report your taxable income only for 12,000. So this is where I am trying to explain to you that in the partnership, you have the flexibility to deduct cost that partnership didn't do for you. But in 1120S, in the S corporation, that doesn't exist. Okay, and that has to be a company expenses going to the company. So this is where the difference, and we want you to have that technical knowledge, then you know which way to partner. So we have a client that, wanting to establish franchise. And to do franchise, and they want to find a person to be in charge of that location, then they want their own holding company to own part of that location. So the best way to make that happen is to have a holding company, and then the partnership is on the franchise location level. So you would have the manager be partner of your company. So this partnership, business partnership, is huge when you really understand the flexibility of it and utilize it in your development of your business. I would say that the person who knows how to be successful in business are the one knows how to find the right partner to form the most effective partnership. All right, so that is all, and I don't think I have any questions coming in, and I hope you enjoyed the session. And I introduced a lot of things, but it's all common things, and it is a great place to start thinking about your partnership. And I will talk to you again. Discovery is a section of how we explain knowledge, and we will be doing other discover as well. And so we will see you again in one of my Saturday 3 p.m. webinar. Thank you for joining me, and I'll see you again.